What's up guys, Jake here, welcome back. In today's video, we're going to do two examples of credit spreads on the companies of Tesla and JP Morgan. In the event you didn't see my last two videos, they go into much more detail about the four kinds of vertical spreads. There are two kinds of credit spreads and two kinds of debit spreads. Now, debit spreads are speculation. There's a low probability of success, but a very high reward if you succeed. You can 2x, 3x, 10x your money. With credit spreads, you would do this in place of selling covered calls or selling cash secured puts. You're trying to net receive a payment today and then have all the contracts expire worthless by expiration date. So once again, we are going to return to my Charles Schwab brokerage account. If you were following my channel earlier this year, you know that I did a brokerage account challenge where I started with $25,000 on January 1st and I tried to actively trade in order to double my account size. And I did that by June. And then I basically took the last 2 months to kind of regroup and regather myself. However, year to date, my account is up 120% or $30,000. With vertical spreads, specifically credit spreads, I'm going to try and get this up to 200 or even 300% by the end of the year. So inside my brokerage account, I basically just have all my fractional shares of the S&P 500 and then 602 shares of this Altisource Portfolio Solutions. I'm currently up 19% on my cost basis. I think this stock is going to 2x or 3x for sure within the next year. So I'm not going to sell this under a year, but by the time I do sell it, I think this will be like 200 or 300%. But I'm going to start filling this brokerage account up with vertical spreads. And I'm going to be favoring credit spreads, but we might do some debit spreads as well. The first credit spread we're going to sell is on Tesla. Tesla has pretty good options premiums, but the downside of Tesla is it's a very expensive stock, $684 per share. So what if you wanted to sell a covered call on Tesla? You would need $68,000 for 100 shares. I don't want to hold $68,000 worth of Tesla stock. So I'm looking to sell a call to collect a premium. And the reason why I'm doing this now is because Tesla just had their earnings report on July 26th. It's currently July 30th. Nothing is happening with this stock. All the moving averages have converged and are now trading around this nice round number of 650. So my opinion is that it's not going to get back up to all-time highs in the next 3 weeks, maybe in 3 months, but I want to sell a covered call somewhere in this range between 700 and 800, but we're going to reference the deltas to make sure that we're getting a good option premium. So back to my Schwab brokerage account, and let's go to the option chain. First thing we have to do is choose an expiration date. I'm going to go with August 20th. That's the third Friday of the month, and it's in 21 days. And let's increase the number of strikes, and let's switch this so that Schwab shows me the Greeks, because I want to reference what is a delta value on the call side of roughly 30%. And it's telling me that for a strike price of 730, the delta is 31%. So I'm going to select this. And because we're doing a debit spread, I have to select another strike price higher than what I'm selling. This is the one I'm going to be buying. Okay guys, there's a couple points in the video where I accidentally say debit spread instead of credit spread. Debit spread is where you pay an amount today for the contracts. Credit spread is where you receive a payment today for the contracts. Everything in this video is a credit spread. So let's go back to the top, and I'm going to sell to open the strike price of 730. You're always selling whatever is closest to the current share price. And then I'm buying to open the one just above that. So Schwab even recognizes this is a vertical call spread. It's showing, it's using the bid and ask prices to estimate a credit. So what's happening here? I'm trying to receive a payment today on one spread of $240. Now, what am I risking here? I'm risking whatever the width of these two strikes is. So this is $10, so multiplied by 100, I'm risking $1,000. But you have to factor in your break-even price, and because I'm receiving this credit of $240, that lowers the amount that I can lose overall. So it's $10 minus $240. I'm risking $7.60 per share, so I'm risking $760 to make a credit of $240, which to me is I think is a good ratio on a stock that I don't think is going to do anything crazy in the next 3 weeks. So let's click on trade and then go to the review page. And once again, we're just reviewing everything. Current share price is $689. I'm selling at $730. I'm buying at $740. So just a quick recap about debit spreads. You can't sell naked calls. Your broker doesn't allow that. That's way too risky. If Tesla were to shoot up dramatically, your losses would be unlimited. By selling a spread, you're capping how much you can lose. With a debit spread, you're capping how much you can make. With a credit spread, you're capping how much you can lose. And what you're making is just the premium for the net difference of the two contracts. So if Tesla's share price in the next 21 days shoots up crazy, gets above 740, I can't lose any more money on these two contracts, because whatever I'm losing from the call that I sold, I'm gaining now 1-for-1 in intrinsic value on the call that I bought. So this is a defined risk, defined benefits vertical spread. Most I can make is $245, and the most I can lose, like I said, was something like $760. Now, because this is a good premium and I like it, I'm actually going to increase my quantity to 2, and this will up it to $490. So I'm looking to make $490 on this vertical spread over the next 21 days. Once again, I could lose $760 times 2. I could lose $1,520. So let's go ahead and execute this. And there we have it. It is now in my account. Once again, this is 2 credit spreads. I received a credit today, net, and I've got a positive 2 with a strike price of $740. Those are the ones that I bought. I want these to expire worthless out of the money, which is weird to think about. And then these are the 2 that I sold. So this is the one, these are the contracts I want to expire worthless out of the money. What am I making? It's the net difference between all of these contracts expiring worthless by August 20th. So that was a bear call spread. It was a call debit spread that I think the share price of the company is going to keep trading sideways or possibly go down, but I don't think it's going to go up. Let's do the opposite now with JP Morgan. And when you look at JP Morgan's stock over the last 6 months, it's basically been channeling or trading sideways. However, there's a very obvious line of support around $150. So it ran up huge last year. We'll go to the 1-year chart. So look how it shot up from about $99 a share, or about $100, up to $150, and it's now channeling sideways. And anytime it gets up, it got as high as $166, it just pulls back to $150. But buyers step in at $150. JP Morgan is currently at $152. I think that this line of support is very strong, and I don't think JP Morgan's share price is going to get below $150 too far. So the plan here is, well, what if I sold a put and then locked up the collateral? JP Morgan's share price isn't that expensive to lock up a cash secured put. That'd be $15,000 or $15,000 in buying power if you wanted to use margin. But I would rather just do a debit spread, a credit spread on JP Morgan. So let's set that up. JP Morgan isn't reporting earnings in the next 3 weeks. In general, with credit spreads, I want to avoid earnings because that's when a stock can often shoot up or shoot down. So I'm trying to avoid earnings if possible. So for JP Morgan, we're going to go once again with the expiration date of August 20th in 21 days. Let's add some strikes here, and we're going to show the Greeks. And this time, we're on the put side. And I was saying that I don't think it's going to get much lower than 150. Now, that's basically right at the money, which is a little close for me. So how about we go with the delta of 31% or a strike price of 148. So that is what we are selling to open. Now, when you sell to open a put, your losses are very high. It's basically if the share price of the company goes to zero, you would still have to buy the stock for 148 a share, even if the company went bankrupt and the share price went to zero. So we have to cover ourselves now by buying a put. And let's go with 135 might be too much, but 140 isn't enough. We'll check out the credit from the spread between 148 and 140. So for 148, we are going to sell to open that. Once again, it's the one closer to the share price currently. And then 140, we're going to buy to open. So it's giving us a credit of 164. That works for me. Let's just go ahead and click on the trade and then review it. So once again, let's calculate our max loss and our max gain. The most we can make on this net credit spread is $113, and we're risking $800. However, you have to factor in your break-even price of 148 minus 113. As long as the share price of JP Morgan stays above 146.87, then I won't lose money on this trade. I'm going to go ahead and increase this quantity to, let's see, maybe 3. Yeah, let's do 3. Let's figure out how much I would make by doing 3. So by selling 3 of these credit spreads, I can make $339. So that's my max gain, and I'm risking, like I said, I'm risking about $2,100. I'm pretty confident that JP Morgan, even if it does dip below 150, buyers will step in like they have the last 1, 2, 3, 4, 5 times. So I'm going to go ahead and go with this trade. Now, what this means is, if I'm risking $2,100 potentially to make $339, my probability of success is high, my reward is low, but I got to be right. I got to be right basically 7 times for every 1 time that I'm way wrong or the market does something crazy. So selling covered calls or cash secured puts, you at least have the stock. You can at least buy and hold the stock through whatever is happening in the market. But with vertical spreads, you lose money. I have a high probability of success, I think, selling this vertical spread, but there's still tremendous risk here. I'm going to do it, but I just want you guys to know vertical spreads, even credit spreads, it's not a guarantee, and you can lose money on these trades. Okay, and this is what it looks like in my brokerage account. So I did 2 different kinds of credit spreads. The Tesla one was a bear call spread. I think the share price of Tesla is going to trade sideways or potentially go down. Going down would be good, but I don't necessarily need it to. And with JP Morgan, this is a bull put spread. I think JP Morgan is going to once again trade sideways or at least go up. And this way I make money. If JP Morgan goes sideways or up, I'll make, I said, what was the credit? A little over $300. It's basically the net difference between my cost basis, because ideally by August 20th, everything here is expiring worthless, and then I keep the net credits that I received for all of these contracts. Pretty cool. Okay guys, that was an example of 2 kinds of credit spreads. I will be doing more examples in my Schwab account going forward. If you like these kinds of videos, give me a thumbs up so the algorithm knows it's good. If you have any comments at all, let me know down below. I love hearing from you guys. Till the next video, take care.